In this video, we'll look at one of our original value investing models, which we base on Ben Graham's style of investing taken from his book, The Intelligent Investor. The key fundamental investing insights here are twofold. First, the market tends to overreact to bad news, which can lead to opportunities in deep value stocks for patient long-term investors. And number two is investors should view stocks as business owners and not just as buying pieces of paper. As you may suspect, the strategy looks for stocks that are among the cheapest in the market, using both the PE ratio and price to book ratio. Stocks also need to have strong balance sheets with high current ratios and low levels of debt. So this combines deep value and financial soundness in one investing strategy. As for the evidence and the source, we base our Graham value model on the book, The Intelligent Investor, as previously mentioned. Graham is considered the father of value investing. Some of the best investors in the world, including Warren Buffett, are cut from the Graham value investing cloth. The investment thesis is this: building a portfolio of deep value stocks that trade at a discount to intrinsic value can provide long-term investors with a margin of safety and healthy returns. The value model combines both financial strength and value metrics together. With all of our models, we stay true to the spirit of the criteria outlined in the original sources. In Graham's day, certain sectors, industries, and size companies were considered speculative. To that end, our model avoids financials and technology companies and also requires firms to have at least $1 billion in annual sales. Financial strength was also very important to Graham. By looking at these measures, it gave Graham more confidence in a company's ability to weather difficult periods, as it avoids companies with high leverage relative to assets. The model requires a current ratio of greater than 2, and long-term debt must not be greater than net current assets. Long-term profit generation is also important. Companies must have increased their earnings per share by at least 30% over a 10-year period, and EPS must not have been negative for any one period within the last decade. Lastly, there are two strict value criteria. The model requires a PE to be below 15, so that in and of itself is a very deep value cut. In addition to that, the PE multiplied by the price to book cannot be greater than 22. These are very stringent value criteria. Deep value investing models such as this one can bring investors into the cheapest, most beaten down stocks in the market, and this is where many great long-term opportunities can be found.